Hello everyone, this is Akhilesh Thakur. Today I'm going to talk about bond valuation by comparing two different bonds, that is bond A and bond B. We will look at how their characteristics affect their value, especially when interest rates change. Um, this topic is very important because it shows how investors make decisions based on the time value of money and interest rate risk. So first, let's try to understand about bond A and bond B. Bond A has a maturity period of 30 years. That means the bond will be fully repaid in 30 years. So it has a par value of $1,000 and a coupon rate of 5%. This coupon rate is the interest rate that the bond will pay every year. And bond B also has a par value of $1,000 and a coupon of 5% rate. But the big difference is that bond B only has 5 years of maturity. So since both bonds have the same interest rate and par value, the main difference is the length of time before they mature. This difference plays a crucial role in how much the bonds are worth today. So, what is time value of money? So this concept explains that money today is worth more than the same amount in the future because money can earn in interest over time. And in bond valuation, the time value of money helps us calculate the bond's present value. We calculate present value of all three coupons, payments, and the final repayment to find out how much the bond is worth today. So in simpler, if you receive money in future, it's not as valuable as having that money now because you can invest it or earn interest on it. uh, Price comparison of bonds. So bond A usually trades at a higher price because it pays interest for a longer time, like 30 years compared to bonds B, that is 5 years. More years of interest payments mean bond A generates more total interest over its lifetime. So investors are willing to pay more for it. However, a longer time to make maturity also means bond A is more affected by changes in interest rate, which makes it riskier compared to bond B. So impact of rising interest rate. Um, so Bondi, since it has a long duration, which is 30 years, its price will drop significantly when interest rates go up. This is because new bonds will be issued with higher interest rate, making bond A less attractive. And bond B only has 5 years left to maturity, so its price is less affected by rising interest rates. This is because it will be repaid soon, and investors don't have to wait as long as for their money back. In short, bond A is much more sensitive to interest rate changes, and its price will drop more than bond B in a rising interest rate environment. Next is percentage price change. So, why do bond prices fall when interest rates rise? Well, it is simple actually. When new bonds are issued with higher interest rates, older bonds with lower rates become less valuable, and investor will demand a lower price for these older bonds because they can get better returns from new bonds. So if you own a bond and interest rates go up, the price of your bond will drop because people will prefer the new bonds with higher interest rates. So this is the numerical example price calculation for each bonds. So We can see bond let's say maturity is 30, annual coupon payment that is $50, current yield to maturity is 5%. So by using the formula, uh, present value of cash flows, this gives approximately $100,000. Similarly, a bond B could say it gives approximately $1,221. Now, let's see the effect of a rise in interest rates to 6%. So new price of bond A could say it's a dollar 845. Percentage change say 15.5% change. So, and new price of bond B is dollar 1186. Scope percentage change is say 2.9%. So from this calculation, we can see bond A has a higher percentage change um, compared to bond B when interest rate rise. Uh, so investment strategy, say um, as an investor, I would focus on some strategies such as invest in shorter duration bonds like bond B. So these bonds are less sensitive to rising interest rates, which reduces your risk. And focus on high quality bonds such as government bonds or bonds with a high credit rating. These are safer investments when the economy is struggling. And will create a bond ladder. This means investing in bonds with different maturities. It helps you reduce risk and ensure you have cash available at different times. And last, monitoring economic indicators. So keeping an eye on key financial indicators so you can adjust your bond portfolio based on the latest economic trends. So these strategies will help to manage risk and ensure um, have a balanced approach to bonds investments during tough economic times. Um, so conclusion must say we have some key takeaways. State the time value of money. So again, I'm say beginning that it is a key concept in bond valuation. It helps us to understand why bonds with future cash flows are worth less than cash today. So bond A, let's say with its longer maturity, generally trades at a higher price, but is more sensitive to changes in interest rates. And last, during an economic slowdown, it's smart to focus on shorter duration bonds and high quality investments to reduce risk. Um, so these are my references. Thank you very much for listening.